Every generation gets one or two moments where the financial landscape shifts so dramatically that the people who understood what was happening walked away with life-changing wealth. The people who didn't, they watched from the sidelines and spent years asking themselves why they hesitated. Right now, in 2026, one of those moments is unfolding. There is a specific signal, one that has predicted every major stock market crash since the 1960s. And it is flashing red again. No exceptions in over 60 years. But here's what almost nobody is talking about. Inside every crash, there are assets sitting at prices that only appear once or twice in a lifetime. And by the time we get to the third asset category, you are going to understand exactly why this moment is different from anything you have seen before. Most people see a falling stock market and either panic or freeze. They pull out, wait for things to calm down, and then buy back in when prices are already high again. That is the average investor's cycle. Sell low, buy high. But there is a smaller group of people who do the opposite. Not because they are lucky, but because they understand what is actually happening beneath the noise. Let's start there. The signal nobody talks about. Here is something that almost no one outside of professional finance talks about. It is called the real earnings yield, and right now, it is about to go negative for the first time in years. Here is what that means in plain language. When you buy into the S&P 500 today, you are essentially earning around 3.5% on your money from corporate earnings. That sounds reasonable, but subtract inflation. And inflation in 2026 is climbing toward 4%, thanks to oil prices that are still roughly 40% higher than they were before the conflict with Iran broke out. And your real return becomes negative. You are losing ground in real terms just by sitting in the market. Now here is where history becomes impossible to ignore. Every single time the real earnings yield on the S&P 500 has gone negative, every single time, the stock market entered a bear market. Look at 1987, a 30% crash in a single day. Look at 1999, the Nasdaq lost 78% over 2 years. Look at 2007, the S&P fell 57%. Not once has this signal fired and been wrong, and right now it is firing again. Why this time isn't just a dip. You might be thinking markets always recover. And you are right. But the question is not whether the market recovers. The question is whether you are buying at the right point in the cycle or the wrong one. What makes this moment particularly dangerous is the combination of two things happening at the same time. First, stock market valuations had already stretched to levels not seen since the late 1990s. The Shiller PE ratio, which measures how expensive the market is relative to earnings adjusted for inflation, was sitting at historically extreme levels. When valuations are high and inflation was low, that could be justified. Investors were willing to pay more for future earnings, because those future earnings would be worth something in real terms. But the moment inflation starts rising, that logic reverses completely. Future earnings are worth less. Investors are no longer willing to pay a premium. And when high valuations meet rising inflation, history shows us the result is almost always a sharp correction. This same pattern appeared in 1967 and again in 1999. Both times the setup looks similar to what we are seeing right now. And that brings us to the part of this story that most people completely miss, where the real opportunity is hiding. The commodity supercycle. Here is where the conversation shifts entirely, because these moments of market stress do not just destroy value, they relocate it. Right now, commodity-related investment funds represent only about 3% of the total ETF market. Back in 2011, at the peak of the last commodity supercycle, that number was 12%. That is a massive gap. It tells you how much capital has stayed away from this space for over a decade. And the structural forces pushing commodity prices higher are not going away. There is underinvestment that built up over a decade. There is a weakening dollar, which means it takes more dollars to buy the same barrel of oil or the same ton of copper. And there is a new wave of demand from artificial intelligence infrastructure, data centers that consume enormous amounts of electricity and require physical materials to build and power them. When capital starts flowing back into commodities, and the early signs suggest it already is, given what gold has been doing, it will push prices across the entire commodities complex significantly higher. 3 places where the money is: So where specifically does the opportunity sit? There are three categories worth understanding. The first is energy infrastructure. These are the companies that own the physical networks, pipelines, power grids, liquefied natural gas terminals that move and store energy. When energy prices are high, their revenues increase. And unlike oil exploration companies whose profits swing wildly, energy infrastructure businesses tend to have long-term contracts that give them stable, predictable cash flows. Add to that the AI data center build-out. The International Energy Agency estimates global data center electricity demand could more than double by 2030. And you have a category sitting in the middle of two powerful tailwinds simultaneously. The second is nuclear power. The largest technology companies in the world, Microsoft, Google, Amazon, have all announced investments or deals related to nuclear energy in the last 2 years. AI data centers need reliable, always-on power, and nuclear is one of the only energy sources that can provide it at scale. The companies involved in uranium, reactor construction, and fuel processing are still in very early stages of a long runway. The third is copper, and this one deserves its own moment. The copper fact that stops you cold. Every electric vehicle uses 3 to 4 times more copper than a conventional car. Every solar panel installation needs copper wiring. Every grid expansion project requires copper. The demand trajectory for copper over the next decade points sharply upward. Now here is the number. When you measure the price of copper in terms of gold, essentially adjusting for inflation and dollar weakness, copper is at its lowest relative price in all of recorded history. Not in the last 50 years, in all of recorded data. Commodity prices are what economists call mean reverting. They tend to move back toward their long-run average over time. If copper prices were to simply normalise from where they sit today, the percentage increase would be enormous, and the mining companies pulling that copper out of the ground would see their earnings increase by an even larger multiple. Because most of their costs are fixed, meaning most of the revenue increase flows straight to the bottom line. This kind of mispricing does not persist forever, so let's bring this together. You have just learned that the same signal that predicted every major bear market since the 1960s is active right now, and that inside this disruption, specific asset categories are sitting at prices that reflect years of neglect and underinvestment. Picture yourself 3 years from now. You understood what was happening in 2026, while the headlines were focused on the panic. You positioned yourself in the parts of the market that were being ignored. Energy infrastructure, nuclear, copper, before everyone else caught up. That version of you is not watching from the sidelines anymore. Here is what to do right now. First, research one ETF in each of these 3 categories. Second, understand how each one generates cash flow. Third, decide on a position size that lets you stay calm if volatility continues. The window is open. It does not stay open forever. Think about it. If you have made it this far in this video, it means this information connected with you. You are not the kind of person who panics and sells. You are the kind of person who wants to understand what is actually happening before everyone else does. Let me know in the comments, which of these 3 categories interests you most? Energy infrastructure, nuclear, or copper? Subscribe to this channel for more content like this. I will see you in the next one.